Before we begin this week's episode of the Grow Your Wealthy Mindset podcast, I want to tell you of a great guide that I made just for you. It's the 12 financial mistakes that keep physicians from building wealth. After talking to hundreds of physicians, I've heard many mistakes, and these are the ones that I thought were most important to share so that you can potentially avoid making these mistakes, or if you've already made them, learn a bit about how you might be able to recover. You can grab the guide at my website, www.growyourwealthymindset.com/12 financial mistakes. Now on to this week's episode. Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Welcome back to the Grow Your Wealthy Mindset podcast. In this week's episode, I thought I'd talk about two different types of returns when it comes to investing. Returns from appreciation and capital gains, and returns in the form of positive cash flow. When people start investing, they often look at the return on investment or how much profit they can expect for their investment. Many people are drawn to investments that predict high returns. An investment where you may be able to double the amount invested in 5 years can sound very appealing. People often think less about when they can expect to actually get those returns. Let's take an example of doubling an investment in 5 years. Let's say you invest $100,000 with the expectation of getting $200,000 after 5 years. Does it matter to you if you get all $200,000 back in 5 years? Or if you get $20,000 a year each year for 5 years, and then the return of your initial investment of $100,000 with that last $20,000 return at the end of 5 years? Both of these scenarios have an equity multiple of 2, where you double your investment over this 5-year period. The latter payment structure is better for multiple reasons. First, you're getting back your money sooner, which means that you can then reinvest to make more money, which increases your returns. The sooner you get back your money, the better. The second structure also gives you better cash flow. With the second payment structure, you could potentially live off the investment. When you have to wait until the end to get back your investment, you have to find other money to pay your expenses, and you can't live on the returns from your investment. So what if the parameters change a bit? What if instead of $20,000 a year, you get $15,000 a year for 5 years, and then a return of your $100,000 principal at the end of 5 years? Now you're investing $100,000 to get $75,000 instead of doubling for another $100,000. Which investment would you choose? The one where you're investing $100,000 and getting $200,000 back after 5 years, but no money during those 5 years? Or investing $100,000 and get $15,000 a year for 5 years, and then the return of your $100,000 principal after 5 years? Your answer probably depends on your financial goals. If you are still working and don't need the investment income for those 5 years, you may desire the higher return over the money being returned to you sooner. You may be in the wealth accumulation phase of your life where your goal is really to increase your assets. If you get the money back sooner, you'd have to spend time looking for another investment to keep that money growing, which is something maybe you'd rather not do. If this sounds like you, you're looking more for appreciation of your investment and less for cash flow. However, if you're looking to cut back at work and want investments to help cover your living expenses so that you don't have to work as much, then getting a decreased overall return, but having regular income from your investment may be more attractive. Perhaps you're in a different situation where you don't have that many different investments, so you would prefer the cash back earlier so you can diversify into more different types of investments. You may also feel like getting your money back regularly gives you more confidence that the investment is doing well and that you would have earlier signs of any issues with the investment if the payments decreased or stopped. If this sounds more like you, then investing for cash flow may be more appealing. Different investments will have varying amounts of return through appreciation or cash flow. With appreciation, the value of the investment increases over time, and your return generally comes from selling the asset that you invested in. When investing in the stock market or Class A real estate, the main return is through appreciation. Typically, when you're investing for appreciation, you're investing in equity or partial ownership of an asset. When you buy stocks or shares of a low-cost index fund, you are buying a tiny percentage of ownership in companies. Over time, the companies grow in value, and each share of stock grows in price. If you want money to spend, you would then have to sell your shares. Class A real estate tends to appreciate more, but the market rents tend to be lower compared to the value of the property. Rents typically plateau at the high end since people who can afford really high rents are more likely to buy. With cash flow, the investment gives returns over time. Stocks can generate cash flow by paying dividends, but few stocks pay high dividends compared to their share price. The S&P 500 dividend yield is around 1.3%. You would have to have a lot invested into a S&P 500 index fund in order to live off that dividend yield. There are some industries that do tend to pay higher dividend yields, like utilities as well as REITs, real estate investment trusts. If you're interested in learning more about REITs, check out episode 143, REITs, the simplest way to invest in real estate, which aired on February 19th earlier this year. The Vanguard High Yield Dividend Index Fund has a 30-day yield of 2.63% with distributions paid quarterly, with an average annual rate of growth in earnings of 9.7% over the past 5 years. It tracks the FTSE High Dividend Yield Index, which tracks stocks of U.S. companies that have paid above average dividends for the previous 12 months, excluding REITs. The index, as well as the fund, lists 589 stocks. Its largest holding is Broadcom Inc., followed by JP Morgan Chase and Company, and then ExxonMobil Corp. There are some individual stocks that have paid dividend yields of over 10%. AGNC Investments, ticker symbol AGNC, which is a mortgage REIT, has been paying over 17%. International Seaways Inc., ticker symbol INSW, has dividend yields that have reached 14%. AG Mortgage Investment Trust Inc., ticker symbol MTT, is another mortgage REIT and has paid up to 12% in dividends. While these dividend yields sound very attractive, it's also really important to examine the company's financial health and stability, since they'll tell you also if they're able to continue to pay those dividends as well as maintain their stock price. When it comes to passive cash flow investing, many people turn to what's called fixed income investments, which includes bonds, certificate of deposits, and money market funds. These are all investments that focus on debt rather than equity. When you buy a bond, you're lending money to a bond holder. You receive interest payments over time and eventually receive the principal when the bond matures. Some bonds may pay a portion of the principal over time. That's typically what happens with a lot of mortgages. Bonds are issued by entities in order to raise money without selling off equity. Governments sell bonds to raise money to run the government or to provide funding for a specific project, like building a bridge. Companies issue bonds to raise capital for investing into the company when they don't want to give away equity or ownership in the company. Banks and credit unions offer certificates of deposits to raise money that they then loan to borrowers at higher interest rates than they pay on those CDs. Episode 34 of the Grow Your Wealthy Mindset podcast, which was released back in January 18th of 2023, discusses CDs in detail. Money market funds invest in bonds, often treasuries issued by the U.S. government, as well as invest in certificates of deposit. When it comes to real estate investing in Class C real estate generally gives better cash flow, but less appreciation. These properties tend to cost less and have a higher rental income relative to the purchase price. There's also often potential to force appreciation through renovations, upgrades, and improvements. Without renovation, these properties don't tend to appreciate as much compared to Class A real estate properties. The tenants are often people who are not in a financial position to buy their own home due to lack of savings for a down payment or poor credit. Another consideration is the tax treatment of your investment returns. Often, when you sell an asset in order to cash in on the increased appreciation, if you held that investment for over a year, Then you will pay the capital gains rate, which is lower than your ordinary income tax rate. When it comes to earning dividends or interest, these returns are typically taxed at your ordinary income tax rate. Real estate is its own beast when it comes to taxes. Your cash flow from property rentals can often be tax-free due to depreciation from the property. One reason I've always found real estate to be an attractive investment is the ability to have cash flow without selling the asset, and the asset can continue to appreciate. There are multiple ways to invest in real estate, depending on how active or passive you want to be and how much you want appreciation versus cash flow. Next week, I'm going to talk about a great investment vehicle for investing specifically for cash flow. Make sure that you're subscribed to the Grow Your Wealthy Mindset podcast so that you can always get the newest episode. You can also sign up for my email list to get a reminder and introduction to each week's episode. Sign up for my email list at www.growyourwealthymindset.com. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. Have a great week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you. Don't forget to pick up your guide, 12 Financial Mistakes That Keep Physicians from Building Wealth. You can grab that guide at my website, www.growyourwealthymindset.com/12 financial mistakes. You'll also find that link in the show notes.